Okay, I think we're now live on Facebook. Jose, if you're watching, maybe you can confirm for us that we are indeed live on Facebook. I am going to be walking through our slide deck today. Let me give you a bit of an agenda of what we're going to be going through. We do have some new clients with us, as well as some prospective clients, as well as some long-time clients. So I will give a little background on who we are. I'll try and keep that as brief as possible. Then we'll jump into the general bookkeeping guidelines and go through some tips on how to keep your information organized. We're going to then talk about our process and what that looks like on our end, so that you can get a feel for timelines and ETAs, so that you can be prepared for the appropriate tax deadlines. Then we're going to talk about the actual documents that are required. This is usually the #1 issue that we face with new and old clients, to be honest, is that we're constantly hunting and pecking for the additional pieces of information that we require. And one of the best things that you can do to improve turnaround time and reduce overall accounting fees is to make sure that you submit all your information with the initial submission, so that we don't have to go back and forth. The back and forth of missing information can dramatically increase the turnaround time, as well as dramatically increase the amount of time that we spend on the file, and coincidentally the bill that results. Lastly, we're going to close by looking specifically at some revenue and expenses, so you can understand what are the types of things that you could deduct. If you are new to independent contracting, this can maybe be a little bit overwhelming and intimidating, and you're not sure what you can and what you can't deduct. We're going to walk you through an introduction to some of the most common things that you can deduct. We've also got an expenses guideline document that we can provide to each one of you that gives you an even greater insight and greater depth and knowledge on the types of things that you can deduct. The most important thing we tell everyone over and over again is that there's 3 criteria with CRA. One, it can't be specifically disallowed by the Income Tax Act, and there's not actually that many things that are specifically disallowed. And 2, it has to be spent with the intent of helping the business earn income. And 3, it must be reasonable. Those last 2 are really subjective, and that leaves the door open to a lot of gray area. And what we want to do is help you maximize the deductions in those gray areas, so that you can minimize your taxes. Because every dollar that you have as a deductible expense is a dollar that you don't pay tax on, either personally or corporately. So that'll hopefully be where the rubber hits the road, and give you guys some really helpful tips along the way. Now, I am going to try my best to stay on top of the chat. I'm just trying to get back to where that is. Bear with me as I screen rotate through this. Bear with me 1 second, because I do want to get that up. So I do encourage people, if they do have questions as we go, to raise those questions in the chat or in the Q&A, and I will do my best to answer those as we go. So let's get into this. So who we are, a little background on our organization. CPA4IT is an accounting firm that specializes in independent contractors. Originally founded in 1984 by my father, George Wall, under the name Wall & Associates Professional Corporation. My dad built up decades of experience, a great team here. Many of our staff have been with us for over 20 years. So we've got a lot of in-depth knowledge specific to this IT industry. And we've also got a lot of processes and systems that we've built over time. A few years back, I went out and branched out and started my own practice that was a born-in-cloud business, very tech-focused, very focused on all the technology that we can use to simplify and improve the process. We've now merged those 2 firms to form CPA4IT, which is a technology firm with years of experience dedicated to helping independent contractors like you minimize the amount of taxes they have to pay. So that's the 30-second elevator pitch, and I won't spend any more time on that unless anyone has any questions. Now we want to start getting into the key elements of the session. So this is a slide that we put in pretty much every slide deck that we have, because making sure that you're educated, that we're asking the right questions to you, and that you're able to understand the way we translate that information is what really helps us to become great accountants. So I need your feedback as a managing partner of the firm. When we're falling down on any of these options, we're not taking the time to educate you. Our team's not asking the right questions. It's not clear the way we're expressing information. I need that feedback so that we can make constant, never-ending improvement to make the organization better for you and for all of our other clients. One of the things many of our longtime clients will know is that we've made some big changes to our final package that we give clients for the sake of making things more understandable. Now you're getting a simplified checklist at the end of the year, which is a 1 or 2 page document, depending upon the amount of tasks that you have to complete post year end, with all of the taxes that you have to pay, who you have to pay, all the appropriate account numbers that you need to pay them. So we've really simplified that down into a 1 or 2 page document that is easily understandable. Of course, you're going to get all the typical financial documents that you would expect, including your financial statements, your ledgers, your minutes, all those necessities that all too often small business owners don't even look at because they're more concerned about the compliance. So our job here is to really make sure that we're educating you, helping you to make informed decisions, giving you the knowledge and the tools to make this accounting and bookkeeping process as easy as possible. I think we do a pretty good job at that, but I'd love to hear your feedback on what we could do to make it even better. Now, some general guidelines for yourselves on what you can do to make the process better for us is to make sure that you're proactive. When we get clients who are coming in 1 or 2 or 3 or 5 years behind, it's really hard for us to maximize the financial benefits of being an independent contractor, because a lot of the tax strategies and tools that we have at our fingertips are really tools and strategies that we need to make use of proactively. We need to be planning for the future, not reacting to the past. And when we are coming in multiple years late, or even 1 year late, it makes it substantially harder for us to be able to do that additional tax planning that's really going to help you optimize your tax strategy and minimize the amount of taxes that you're paying. And then, of course, another really critical element with an incorporated entity is understanding that the more money you actually withdraw from your corporation, the more money that you're going to pay in tax. The reason that that happens is because on the personal side, you have a marginal tax system where you have different tax brackets, and the income between those tax brackets is taxed at different amounts. And the highest marginal tax bracket, over $220,000 here in Ontario, is over 54% tax rate, versus the corporate tax rate, which for small businesses, for Canadian controlled private corporations that are small, that are entitled to the small business deduction, it's only 12.5%. It does go up higher when you talk about investment income, which they refer to as passive income, or once you break the small business deduction threshold, which is $500,000. If you do have more than $500,000 in net income, that's your revenue minus your expenses, then the income over $500,000 is taxed at a different rate than the small business tax rate at 12.5% here in Ontario. So that's important to know, but the more money that we can shelter inside this corporation and pay tax at only 12.5%, the more tax savings that you're going to achieve. Because even at the lower tax brackets, you're talking a difference of between 12.5% and at least 30%. So there's always going to be benefits from having the ability to leave money inside the corporation. In addition, you're going to get access to a whole bunch more tax planning strategies when you have retained earnings inside your corporation. There's tools like individual pension plans. There's tools like the ICE maneuver, which is this really interesting insurance product. There's a lot more options that are available from a tax planning perspective for a corporation than there are for an individual. And the key of that, as I said, is to actually sit down with your account manager and do some planning. So part of our year-end review process is obviously to do some tax planning with you and to start looking forward. So we look at where you are now, where you want to get to, and how you're going to get there. That starts with a personal net worth assessment, some goals for financial freedom, and then we start pulling in the different tax strategies that we have available to us and to see if they might be applicable for you. So those are the high-level guidelines. Now let's talk about specifically bookkeeping guidelines. Probably the most important thing is to develop a system and a process so that you're not falling behind. We talk a lot about all the technology that can make this process and your systems substantially easier, faster, more efficient. And we will be speaking to those in our next session when we talk specifically about bookkeeping. But no matter what you're using, whether it's an Excel file whether it's QuickBooks Online, whether it's some other general ledger system, you want to develop a system and a process for yourself, whether you're doing that monthly or even quarterly, or God forbid annually, which all too many of you are doing. Develop a system and a process that allows you to systematically go through all of those transactions and process them in a timely and effective manner so that you can make sure that you're not missing out on deductions. Because if you don't have a system and process in place, the odds of you either falling behind and missing tax deadlines and paying unnecessary penalties to the government increases substantially. And of course, the propensity to miss out on deductions that you're eligible for, whether you've missed out on some cash receipts or you've missed an entire statement, which we have seen happen more often than you'd think, then you're missing out on potential deductions, and you might have perceived higher cash withdrawals and therefore higher personal salaries than what you really have. Next is keeping your information organized. This is critical because it's not uncommon for people to go through audits, unfortunately. There's something called a desk audit, which isn't a full-blown audit, where they will look at a specific account and want to get some information about that account, whether it be automobile expense, whatever the category. And they'll want to see, most commonly, the 10 largest expenses for that category during a specific time range. And if your records aren't organized and you can't go back and locate that supporting documentation, you are going to definitively lose those deductions, plus have the potential for moving from a desk audit to a full-blown audit, which can take substantially more time and be substantially dig deeper into your wallets and into your pocket, which we want to avoid at all costs. We are such advocates on keeping your information organized that we've gone so far as to go out and purchase a technology that we have licensed for every one of our clients. It's called Receipt Bank. A lot of you have probably heard about it. We again will be doing a whole session on Receipt Bank. It's going to be called Audit Proofing Your Business. It's going to be a combination of talking about the different audits, audit risk factors, things you can do to minimize audit risk, as well as specifically how to use Receipt Bank, which we think is arguably the most important tool for keeping your receipts organized. It gives the ability to simply pull out your phone, take a picture of that receipt, and now have a permanent digital record. I don't care if you're actually linking that permanent digital record to your bookkeeping, which would be the ideal format, but even if all you are doing is taking the picture of your phone, plugging it in a Receipt Bank so that it is locatable when you go through an audit, because in Receipt Bank, you'll be able to actually go in and search by vendor, by date, by amount. You'll have a whole lot of tools at your fingertips to be able to pull up this information quickly. I was actually speaking with a client just this morning that was actually taking pictures with his phone and just forwarding it to an email address, which is a great first step. He's gotten into the habit of taking that picture, but being able to locate and sort through those transactions would be a difficult and time-consuming process. With Receipt Bank, that can be substantially reduce the amount of time that you spend. And this ties into the last point, which is to remember to keep old invoices and receipts. Officially, you are required to keep records from 6 years from your notice of assessment. And that's not 6 years from the tax year, it's 6 years from the notice of assessment. It actually gets even more complicated because if there's a transaction that dates back but is related to a transaction that is within 6 years of your NOA, you're required to keep that document. Imagine the purchase of a house that you might be claiming for capital gains exemption. You obviously have to keep the records of that purchase well beyond the original purchase date, which might have been 10, 15, 20 years ago. So making sure that you're keeping that documentation and having it available to locate quickly is really critical to the accounting and bookkeeping process. Now, the next step, once you've kept all your records in some form of hopefully digital format, you need to choose a method or a bookkeeping tool that you're going to use. And there are a lot of options for you to choose from. Everything from great cloud accounting applications like QuickBooks Online, Xero, not so great QuickBooks, not so great accounting applications like Wave and FreshBooks, which are still cloud accounting programs, not quite as good in our perspective as an accountant as QuickBooks Online or Xero, to tools like our Excel file, which we have a standard one called our CRED manual, which stands for capturing revenue and expense data, and even a full-blown general ledger desktop-based software. So this scale sort of tells you the amount of time, the amount of time required to use those tools and the amount of knowledge required to do them. Typically, a general ledger system is going to require the most amount of time as well as the most amount of knowledge. As you move down that scale, Excel, most people are very familiar with how to use Excel. It doesn't take a huge amount of time or knowledge to be able to use it, but it's also not a general ledger system. It's not a full-blown accounting application. For many of our small business owners who are very simple corporations from a traditional standpoint, using an Excel file is acceptable. Now, what I would say is, if you're going to do an Excel file, you might be amazing at pivot tables. We got IT consultants who can build the fanciest pivot tables you've ever seen in your life. But if we as a team have to learn and understand how that pivot table was used, it can take us, it can take us more time, which ultimately results in higher fees for you to learn and understand where that information is gathering from. In addition, we have been through situations with clients where there was something unique in their pivot table and something was left out and we weren't able to locate missing transactions and they lost out on deductions because it wasn't clear in their information. So if you are going to use an Excel file, we do strongly encourage you to use our Excel CRED file. It may not be as great as a pivot table as what you use, but it's a standard format that we've seen for over 30 years. So our team knows how to deal with that as effectively as possible. Now, that being said, I'd much rather see you using a cloud accounting application like QuickBooks Online or Xero. These are full-blown general ledger accounting softwares that allow us to interact with them. We can go online, we can pull down reports as we need them, we can do adjusting journal entries as we need to. All the information is at our fingertips, and these are true full-blown accounting applications. And the best part is, because they're cloud-based, they have the ability to pull and fetch information from bank feeds. They have the ability to use artificial intelligence to create automatic rules and classify transactions, which can substantially reduce the amount of knowledge required and the amount of time it takes to use those. So the cloud bookkeeping services like QuickBooks and Xero, from our perspective, are going to take the least amount of time and require the least amount of knowledge to be able to use them. Of course, the one thing we didn't talk about on this spectrum is cost. And there are different costs associated with these. Excel and CRED are perceived to be free. Now, I stress perceived there because you probably have the application for free with your Microsoft Office suite, or you're using Google Sheets and it doesn't cost you anything. But where you're losing out and where it's costing you is in the opportunity cost. The opportunity of having better financial information at your fingertips, the opportunity cost in making sure that you're not missing out on those deductions. Cloud-based systems versus general ledger programs. A cloud-based system is probably slightly more expensive in outbound costs versus a general ledger desktop system, particularly if you're not actually updating your general ledger system on a regular basis, which all too many of you are not doing. But you're also not getting those time-saving tools and technologies that, when you look at the overall cost, cloud bookkeeping solutions are substantially cheaper. And as many of you know, we also offer wholesale pricing on QuickBooks Online and can give you the best prices in the market on that. Looks like we have a Q&A. I've just noticed that now, so let me see if I can pop in. Where can you find the Excel CRED file? Great question. So we have a free resources library inside of your client portal. We use ShareFile as a client portal for our clients, and you can log in on our website. In the top left corner, I believe it is, it says client login. You log in there. One of the libraries that you have available, one of the folders that you will have available, is your own individual reports and upload folders for your company and for your personal taxes if we're doing both. For some of you, for multiple companies, as well as a free resources section. Under the free resources section, you will find a folder called bookkeeping. Under the bookkeeping folder, you will find our CRED template. So if anyone struggles with locating that, please let me know. We can email you a direct link on that. So, next thing we wanted to talk about briefly was the HST methods. For those of you who've been with us for a while, you're on an HST method, you know how to deal with it. It's probably, you can tune out for a few minutes while we talk about this one. But if you're new to accounting and bookkeeping, you may not be familiar with the GST HST process and what the different methods are for collecting and remitting HST, and why this is so important to the accounting, to the bookkeeping process. And it is critical to the bookkeeping process, and you need to know and understand before you start the bookkeeping process what methodology you're using, because they are substantially different when it comes to reporting your expenses. I'm going to start by giving you a difference between the two, and then I'll explain why it's so important to know which method you're using in just one second. So the long method, we'll start there, is subtraction. So you have the revenue that you collect, which in this case is $13,000, minus the HST that you paid on various expenses, which in this sample is $1,100. So as a small business consultant in the services industry, your largest expense is probably your own salary, then secondarily your home office, both of which don't have HST on them for the most part, and then your automobile expense, which may have some HST on it, and then you start getting into business promotion, meals and entertainment, and the grand sum, outside of your salary might be, $30,000 to $50,000 worth of expenses, but not all of those expenses will have HST on them. And in the long method, you're taking what you've collected, you're subtracting what you've paid in HST, and you're remitting the remainder to the government. Now, when you're doing your bookkeeping using the long method, you must break out the HST on the individual transactions. So because we're keeping track of each expense, the HST on each expense, that actually has to be separated, and it has to be separated during your bookkeeping process in whatever format that you're using. Now, the quick method is different. The quick method is, I'm not a big fan of the way we've explained this. It's multiplication. It's not subtraction. So what I mean by that is, in the quick method, instead of taking what you've collected, subtracting what you've paid, you simply pay the government 7.8% on the first $30,000 of revenue, plus 8.8% of any revenue over $30,000. So in this situation, it would be 2,340 plus 7,304, which would be a remittance to the government of $9,644. So for most independent consultants, this multiplication method nets out in a better deduction and lower taxes payable, because the assumption here is that you're paying 13 minus 7.8% and 13 minus 8.8% on anything over $30,000 in HST. The reality is most of you probably aren't spending anywhere near that in GST HST. So using this method will result in a lower GST HST payable. The only caveat to that is if you have a US client in which you are not collecting HST, then 0 minus a number is a loss, 0 times a number is 0, and a loss is better because we can apply that loss to get taxes back that you have paid already on those expenses. So if you've got a US client, probably the long method is better. Outside of that, the quick method is better because it's going to result in you paying less tax. Now, here's where the rubber hits the road when it comes to bookkeeping, is when you use the long method, you've got to break out the GST and all your expenses, and the deduction you get for the expense is the total expense minus the HST that you paid on that expense. When you use the quick method, you do not need to break out the HST on the expense, and you get to deduct the expense including the HST. So if you spent $100 plus 13% HST, using the long method, you would have a deduction for $100. Using the quick method, you would have a deduction for $113. So in addition to you paying less taxes on GST, HST, you'll also pay less corporate taxes. So it's a substantially better process for independent contractors. However, you can't just arbitrarily choose which method you're using. You have to actually file an election with the government. You can swap back and forth from one method to another, but that must be done with an election, and that election must be done proactively. You can't go back in time and change that for a period that has already ended. So again, this comes back to what we talked about earlier about the importance of being proactive and planning for what the next year looks like, so that if you're going to be switching from a Canadian end client to a US end client, that we look at switching from the quick method to the long method, or vice versa. Now, important dates to remember. This is something that's critical for you guys to be aware of. There are a number of different dates flying around there when you were a small business owner. There are payroll deadlines, there's corporate tax deadlines, there's GST deadlines, there's deadlines for filing and preparing your T4s. There's still all the personal tax deadlines that you have to be aware of. So we do have reminders that we send out to all of our clients to make sure that you're aware of these deadlines as they come. But I just want to take a minute to run through them really quickly. I'm going to skip the top line item for a second because source deductions and payroll are arguably the most complicated. I'm going to start with two of the easier, more simple ones. So the deadline for filing and preparing your T4s and T5s is February 28th of the year following the year in which you're preparing the T4 or T5. So if I was reporting salary that goes on a T4, I would create a T4 by the end of February 2020 for the income that I'm reporting for the 2019 year. And the same for the T5s. Now, T5s are specifically for dividends, not salary, but also have the same deadline. On the personal tax side, as many of you know, we have an April 30th deadline to file and pay your personal taxes. That's still relevant even though you have a corporation. You will still be receiving either a salary or a dividend, and you will need to report that on your personal taxes. So keep that in mind. Now when we talk about GST, HST, which is a little bit more complicated, not terribly, but there are, if you're on a filing method that is annual, which is what we set most of our clients up, your filing due date is 3 months after your year end. If you were filing quarterly, which is the default method that CRA sets you up as, that is if we didn't do your incorporation, then it's 1 month after each quarter. So you have to file more of them and you have to file them sooner, which is a big reason why we switch all of our clients over to quarterly filing, or over to annual filings from quarterly filings. We also make sure that your year-end date for GST, HST coincides with the year-end for your corporation. By default, it will be December 31st, which may or may not be the year-end for your corporation. So you want to make sure that you're switching the year-end of your GST, HST to coincide and match with the year-end of your corporation. Next is corporate tax. Corporate tax has got two funny deadlines. First, let's start with the 6-month deadline. 6 months after your year end is what they call your filing deadline. It's a bit of a misnomer because while you have to file by that period, any penalties for being late are a percentage of the outstanding balance. So if you are late, but you've made all your payments, there's no actual penalty for missing that 6-month deadline. So 6 month is really the hard stop deadline. But there's one other deadline for corporate tax, and that's 3 months after your year end. 3 months after your year end, your payments are due. What that means is from your year end date until 3 months after your year end, there's an interest-free grace period. So no interest, no penalties, you're good to go. After 3 months after your year end, your corporation begins to accrue interest on any taxes it owes. It doesn't actually have to file the return yet, but if it hasn't made any payments, it begins to accrue interest from 3 months until that 6-month deadline. And then after the 6-month deadline, it's now interest plus penalties going forward. So that's important to know and understand. Lastly is the source deduction deadline. Now we've got here January 10th or 15th. There's also potentially January 3rd. And in fact, we're moving all of our literature to start focusing on January 3rd as the deadline we want all of our clients to focus on. There are different thresholds And based on the thresholds, you could either be due the 3rd of the following month in which you paid your employees, the 10th of the following month in which you paid your employees, the 15th of the month in which you paid your employees. So to keep it simple, we're focusing everyone on the 3rd date following the month in which you paid your employees. The reason they've got January 10th and 15th up on the screen here is because that's the most common remitting period, because it's the last day in the year that you can possibly declare a salary. And so since we're trying to defer taxes as long as possible, we try to bonus the salary at December 31st, as long, or at least as late towards, or as close towards that December 31st period as we can, so that you don't have to pay the taxes until you absolutely have to. Your accountant will certainly talk with you about the different tax planning options and whether you might have different filing deadlines for this, because some corporations, like let's say for example, that you have a March year end. The rules tell us that we can bonus income out 6 months, which would effectively make that due by the salary would be paid by the end of September, and then the source deductions would be due in early October. So there are different thresholds for other people. Keep that in mind, and your accountant will certainly make sure that you're aware of all those deadlines and when to pay those. Now, we want to do a brief breakdown on what are different costs and things that can cause cost overruns, because anyone who's not on, as I said earlier, either our pro or exclusive packages means your time and materials. And the reason we do that is because people can bring us in a great set of books that are really clean, really well organized, and other people can bring us in, you know, what is the exact same end result, but in a really poorly unorganized fashion, and it takes us substantially more time to clean up that unorganized fashion. So what are the things that make us spend more time? As I said earlier, the biggest thing is incomplete information. So I'm going to go through with you later today a checklist of all the information that we require, you know, making sure that you give us 12 months bank statement, and then the 12 months actually covers the 12-month period. We see that all the time, a missing month in the middle of the statements, or you have given us the corporate bank account, but you haven't given us the corporate investment accounts. So making sure we're getting all that information complete up front will make sure that we're not spending time chasing you down, because every time that we have to chase you for information, someone has to record that time, and you're getting billed for that time, typically in 6-minute increments, which is the 0.1 of an hour, which is the lowest increment that can be put into the time and billing system. So every time we're following up with you, even if it's for the most simplest things, you're getting billed for 6 minutes. So make sure that you give us that information as complete and accurate as possible, because obviously the other problem we have is when information is inaccurate. So you've given us one cred and then you make a bunch of changes. You give us another cred. You know, we spent a bunch of time on the first cred manual and now it's tossed out. Or information that's unclear. Again, when we talked about earlier, when we have, you know, a pivot table that you've spent hours creating, and it's this amazing pivot table that you know and understand like the back of your hand, but we've never seen it before, and we're not familiar with all the different places we should be checking for information, and it's not clear to us what information we should be using from those pivot tables, it can ultimately end up taking more time from us and more cost for you. Now I want to take a minute to just walk through what our process looks like. So when you give us all the information, we will do a preliminary review of the file to scan it and make sure that we've got most of the information that we need to proceed. We will then send an email to you notifying you that we've received your information and that your file has been logged into the process. If you don't get that email, something has gone awry, we haven't received your email, it's gone to junk or spam or something like that. So make sure, or if you're uploading stuff to our client portal and assuming that we're aware of that, no, you have to actually notify us. Yep, I've uploaded all my information, we are good to go. We will do a preliminary review of that information to make sure that we've got most of the information. If we've got enough information to begin the process, we will do that and send you an email with what pieces of information that we do require. It then goes into our preliminary data entry stage. They take all the information from your general ledger system, put it into our working paper software, reference all the transactions. Probably one of the most time-consuming aspects of our process. Once that's done, we do have a review meeting prep that we go through where the supervisors are making sure that the information is accurate. It's our first sort of QA, quality control check, to make sure that the file has got everything referenced accurately and we have processed all the necessary information. Once the account manager is happy with the status of the file, he will promote it to stage 4. You'll get an email requesting a review meeting. That review meeting can be booked in the account manager's Calendly calendar, which is the best way to do it. You can have a review meeting either in person, over the phone, or using Zoom, like we're doing today. I highly recommend Zoom is the best way. It saves you having to drive down here, deal with traffic, deal with parking, all those things. And we're able to share screens and have a really interactive process that is very effective. Once we've had that review meeting with you and you've given us maybe some additional information, we've gone through the benchmarking analysis to see what additional expenses we might be able to add. It goes through a secondary data entry to add any additional transactions. Maybe we're gathering some more documentation from you. Once we're done that, it goes into finalizing. During finalizing, there's a last quality control on the process. And then finally, we create the year-end package that you're used to seeing, which now is all digital. Again, we upload that to your client portal. If anyone does want a paper package, we will provide a paper package upon request. But by default, everything is provided in electronic format and uploaded to your client portal, which is a secure and safe space that you'll have a permanent record on. Then once we're done with that, we release the package and issue an invoice for any outstanding time and materials. So that's our year-end process in a nutshell. Now let's get into, again, some more recommendations. And I do apologize, guys. This is the first time I've done this webinar in a while. So I'm a little bit rusty, and I do see that there are some questions in the chat. Let me just see, take a minute to take a look at that. For QuickBooks Online, would the self-employed edition be sufficient or better to go with the next up level? Yeah, if you're a corporation, you can't use the self-employed. It's limited in its chart of accounts. It doesn't have a balance sheet. It doesn't have everything that's necessary for a corporation. So self-employed is meant for sole proprietors. If you're a sole proprietor, it's a great tool. It's, I think, $5 a month. So it's really cheap. It does also come with something similar to Receipt Bank built into it. It's a little bit different, but that is something to be aware of. Is default the long or simplified method for new corporations? The default is the long method. The default is quarterly, and the default is December 31st as the year ends. So if you created your own GST, HST, and made no elections with them, that's what it's going to be. So what you can do is log into your CRA My Business account, see if there's been any elections made, or you can always call in to CRA, but you never know how long you're going to wait on hold when you do that. Jeez, I'm jumping around here. So our recommendations for you guys on the bookkeeping process, and I'm realizing I probably need to pick up the pace a little bit. Ideally, you're using only one corporate credit card and one corporate bank account just to keep your information organized. So if you cannot get a corporate bank account, then use a personal credit card like a corporate bank account. Keep all that information as separate as possible. We do recognize that, particularly in the early years, there's going to be an intermingling of business and personal, and that's okay. What we'd rather see you do is put some personal things on what is the corporate credit card or corporate debit card than the other way around. We can always classify transactions that are not business related into the director's advance account, thereby not deducting them as expenses. So you're better off to make sure that you are overusing the corporate credit card rather than underusing it. But if you have one corporate credit card and one business bank account that you use, that's sort of the ideal structure. You do want to leverage automation and artificial intelligence as much as you can using tools like QuickBooks Online and Receipt Bank to make that process as efficient as possible, and to make it as approachable as possible, which ties into the next thing, which is making sure that you're doing your bookkeeping on a monthly basis. I know you don't have to file your taxes for a full year, but if you leave your bookkeeping to the end of the year, it's going to make that process. Oops. Sorry, guys, I think I lost audio for a second. Hopefully it's back up. Give me a second to check that. Yep, I think we're back up. If I've lost audio, please flag me. We've got some more questions in the QA, so bear with me a second as I look at the QA. How do you file an election with CRA? Can CPAHIT provide instructions? Well, we can do the election for you. I can't really provide instructions on how to do that. You can call CRA and they may walk you through the process, but we're always happy to help you with that, and or guide you to CRA and give you the instructions. I'm a new client with exclusive package, assuming I will be contacted to set up receipt bank and QBO setup. But what will happen to my data if I choose to not retain your firm for the next year? So your information will not be lost. Yes, someone will be reaching out to set up those accounts for you. With QuickBooks Online, they officially say that, let's say that you choose never to use, you don't want to use QuickBooks anymore at all. That information can be downloaded from using their reports. They will, if you stop payments, stop using the account, they will keep the information for 1 year, is what their official rules are. I know in speaking with Intuit, have pretty good connections there. In Canada, they have yet to purge any data. They might, in their official rules, say they'll keep it for 1 year. To this date, they haven't purged any data. You can, of course, transfer your account to either your own payment methods, because if you're on one of our pro or exclusive packages, all that software is included in the one fixed fee price. And in fact, I do appreciate you attending this seminar because it might be insightful, but all this stuff we're talking about and all this stress of bookkeeping, you don't have to worry about. That's the great thing. We'll be taking care of all that for you. Of course, we will need to work with you to gather that information to make sure we're connecting all these information and feeds to leverage that automation and AI. But assuming you want to continue with QuickBooks, you just transfer the payment either to yourself or to your next accountant, and that data would flow through. If you want to, like I say, close it down, you can come back in up to a year later and re-engage that account and have access to it, or you can just print out all the necessary reports and download that information. One of the things that we do in the accounting process, so once the bookkeeping is done, we take out a whole set of reports from the bookkeeping software, all the information that we would ever need to go through an audit, even if we didn't have QuickBooks. Like it's the requirements for us for how we create our working papers, the documentation, the information required, that all must be contained within the working paper file. Even though the information is there in QuickBooks, we can't rely on it always being there. So we take out all the necessary information. You could very well do the exact same thing. We've got one other question here. Will my access to QBO and receipt bank be all canceled so I lose all the data? Well, no. So this is somewhat related to the first one. You won't lose your data. If you're transitioning to another accountant, we would certainly give you the option to take over that account, transfer it to your other accountant. Of course, if you don't respond to us and don't tell us that you want the account, then we will cancel the account. And then you've ultimately got 1 year to reactivate that account and regain all that information. So hopefully that answers your question. I think we have, no, people just telling me my sound is good. Awesome. Thank you, everybody. Talked about the process, update your bookkeeping monthly, complete your home and auto worksheets. Again, this is something, even if we're going to be doing the bookkeeping like those on our pro and exclusive package, we do need to work with you to complete your home and office worksheets, because these are percentage of use categories. And this is one of the areas that we actually can go above and beyond in helping you to maximize those deductions, because we've got some unique formulas to help you maximize the rates, percentage of use rates, and certainly talk with your account managers about how you can optimize those. Required documents. Okay, so we've got 2 slides on the required documents, one for new clients, one for existing clients, because when we're dealing with a client for the very first time, we need a few additional pieces of information, like your previous year's financial statements, your previous year's trial balance, your previous year's tax return, previous year's adjusting entries, the articles of incorporation, and your initial minutes. You don't need to write all this down because it's certainly one of the things that Rachel will be making sure it's clear to you what we need from you. And oftentimes we will begin asking you for this information as soon as possible. Of course, if you're a new client, but this is your first year of operations, most of this will be irrelevant. The only thing that is going to be relevant no matter what is the articles of incorporation and your initial minutes. Now, if we've done your incorporation, we will have access to that information. So there's literally nothing more that you need to provide over and above what is required for a typical year end for a client. But if you're coming from an existing accountant, we will need your previous year's financial statements. We will need your previous year's trial balance. We will need your previous year's tax return, and we will need your previous year's adjusting entries. These are standard reports that all accountants should be providing to you anyways. So it should be really easy to access and gather that information. One of the other things that we need, which I'm sure is under the existing clients, is access to CRA. So we're saying here we want the notice of assessment from the prior year, which we do want, but we can actually gather online if we have your online access. So getting CRA access is something that is really critical for us because it can substantially improve so many parts of the process. There's a lot of information that we can gather and collect directly from the client portal, or sorry, the CRA portal, rather than having to call into the CRA department, which could take, we never know how long we'll be on hold for. And the reality is, yes, we will be billing you for the time that we spend on hold, because everyone in my organization is responsible for their time, and that time has to be allocated somewhere, even if that time is spent sitting on the phone, which is not how we want our team spending their time. We want them adding value and doing things that can add insight rather than sitting on hold with CRA. So the online access is key. Keeping in mind that if we don't have access to deal with CRA as your representative, we can't even call in. So we'll spend that time on hold only to be told that they can't help us. Next thing that we need to have is 13-month bank statements. So we ask for 13 months bank statements so that we can have the first month of the next fiscal year, which helps us just confirm any accounts receivable. Accounts receivable is revenue that you earned during the year but haven't been paid for yet. So most commonly with independent contractors, you'll have one voice at the end of the year. Let's say your year end is December 31st, and you'll issue an invoice dated, from December 16th to December 31st for X amount of dollars, and you'll get paid for that maybe sometime in early January, maybe even February, depending upon the payment terms that you have with your client. That is still considered revenue during the year if your year end ends December 31st, regardless of whether you have received that money. And the money that you have not received goes into account on the balance sheet called your accounts receivable. And one of the ways we're able to reconcile and confirm that is by looking at the 13th month bank statement. We can begin the process without the 13th month statement, but it is very helpful for us to be able to confirm that accounts receivable. This is probably the thing that people get wrong the most. It's really easy for people to miss a month, to accidentally download 2 December statements instead of a November end of December statement. Happens all the time, and going back and forth and getting that information can be time consuming. Now with Receipt Bank, there is the ability to fetch your bank statements using Receipt Bank. It's in beta, so it's still early. We're really excited to get that to the point where we can actually be able to have you connect Receipt Bank, have that pulling all those bank statements without us having to hound you to provide us that information. For investments, if you do have corporate investments, we do need all the investment statements. We need the T3s, the T5s, which are the investment slips that you'll get. Sometimes there are timing differences on this. Like if your year end is not a December 31st year end, it might be quite some time before you get the T3s and T5s, which again are typically prepared, in February for you, February or March, then you may not have those yet. But we always need the T3s and T5s from the prior year. What we do is we have a way of tracking all the transactions from the investment statements. And what we'll do is record the revenue that hasn't come through on a T3 or T5 slip as a balance sheet item that we expect to be recorded the next year when we receive the T3s and T5s. One of the other important things that we need when it comes to investments is something called a T1135. There is a filing requirement that is a couple of years old now that says if you've got more than $100,000 in foreign investments, that you need to report that. And there is a $25 a day late penalty for not filing that T1135 slip. The T1135 is a standard report produced by your financial advisor or whoever you're using for your investments. They can print it out very easily. The one thing that most common mistake we see with this is that the investment advisor will give you a calendar year and we need a fiscal year. So not necessarily from January to December, but if your year end is July 31st, then you need from August 1st to July 31st. So that's one of the big things that we need there. Of course, we need all your revenue and expenses, which would be things like your QuickBooks Online, Access, your cred manual, the general ledger and trial balance from your working paper software, the list of all the revenue and expenses that we're going to use for primary referencing, the home office worksheet, which we mentioned before, and the automobile worksheet, both available again in this client portal that we talked about earlier today. So you can download all of that. We will need that each and every year from you. And those are the core pieces of information that we do need. We do have a process to make sure that we're getting all that information, that we're following up with you on a regular basis. Hopefully you find that process useful. Once you have gathered up all this information, you need to share it with us in some way, form, or another. There are a couple of different options for how you can do that, and we have preferred ways and less preferred ways. So the least preferred way is to mail or drop off that information. That does then mean ultimately we have to scan that information and digitize it so that we can put it into our electronic files. That again means more time and more time spent by the team. So if you've got the documents already in electronic format, please do upload them to your client zone, which is our preferred method. Yes, you can email documents to us, but email is not secure, as many of you know. So we'll certainly accept it, but we strongly encourage everybody to upload their information to their client zone. Inside of your client zone, when you log in, you'll go into the folder with your company name in it. You will see a client submissions folder and a reports folder. The reports is where we'll upload all the reports that we're providing to you. The client submissions is where we expect you to upload all the documents that you provide. Now, unfortunately, our system is not set up to notify us whenever you upload documents. So once you've uploaded everything, please do send us an email and notify us. Quite frankly, to be blunt, it's not that the technology doesn't have the ability to do that. We started off doing that and it created more problems than it solved, because people would upload information in drips and drabs and they weren't ready for us to start the file, but they've uploaded information. So what we're waiting for is your go ahead to say, everything's in there, we're good to go, start the accounting process, please. So you can upload information all throughout the year as you gather it. It's a central repository that we'll make available for you. If you ever leave us, we'll give you the ability to come in and download all that information, pull it all off and download, which you can do at any given time that you'd like. So those are the different ways for submitting the information. Now, I've ran a tad long. I've only got about 7 minutes to talk about the different things that are deductible. I'll try and move through that quickly. I just want to open up to see if there's any more questions in here. Didn't know we will all be taken care of. Thanks. Not sure what that was in reference to, but you're welcome. Will my access to, okay, that's the original question. So I think that's all answered. Let me just look at the chat right now. Can I talk about the average fee if there is time? Sure. So the average fee for someone who's doing their own bookkeeping is about $2,400 a year. Obviously, when you talk about averages, that you could be above or below the average. So it depends on how well organized your information is. But that average has been built up over 30 years. It's pretty unlikely you'll be substantially above or substantially below that. And we do our best to try and communicate whenever we do identify issues that are going to substantially increase the amount of time that we spend. So we'll obviously relay that back to you. Like, look, we've come across this big issue. We had one client the other day who'd actually done his bookkeeping in QBO, but unfortunately required a lot of cleanup on our end afterwards. And so we had to go back to him and say, this is going to be a little bit more expensive than we anticipated and take us longer because QuickBooks is an amazing program, but you can still garbage in, garbage out, folks. So if you're not keeping your information organized, it can mean cleanup on our side, which is time consuming and costly. That's why those fixed fee packages are great. So we talked earlier, there's a gentleman on the call who's in the Pro and Exclusive. Those are fixed fee, which means that it doesn't go up or down with the amount of work. There's a scope of work that is included for those fixed fee packages. And as long as you're within that scope of work, the price does not change. So let's talk a little bit about what's deductible. So as I said earlier, it can't be specifically disallowed by the Income Tax Act. If it's not specifically disallowed by the Income Tax Act, it just has to be incurred with the intent of helping you to earn business sometime in the future. So what is specifically disallowed by the Income Tax Act? Let's start there. So golf green fees, specifically disallowed. The drinks and the food at the golf course are deductible. So if you go down with a group of 4 guys, make sure one of them picks up the green fees and you pick up the drinks or something along those lines. Your home telephone line, specifically disallowed. It's a basic right that you're entitled to and is therefore not deductible through the corporation. But any long distance, any cell phones, any VoIPs, and in fact, I think the landline is going the way of the dodo. Most people don't have them anymore. But all of your internet, all of your cell phones, all of your long distance, that's still deductible. And then insurance is another one that's specifically disallowed. Insurance is a funny thing. I should say life insurance is specifically disallowed. Errors and omissions, health spending, disability can all be deducted. Disability, caveat there, if you choose to deduct it, any benefit you receive is taxable. So while you can deduct it, we typically recommend that you don't. Life is specifically disallowed, but if you make the corporation the beneficiary, it can be paid for with money that's been taxed at the corporate tax rate as opposed to money that's been taxed at your personal tax rate. It's a little bit more complicated. In the 3 minutes I have left, I'm probably not going to be able to get into that. The rest of this is open to interpretation. The best tool that we can help you to maximize those deductions is our benchmark analysis. It will pinpoint areas where you're below the average. We will work with you to ask some questions to figure out, hey, look, the average person is deducting, a couple $1,000s in, I don't know, let's say education and seminars, and you've got nothing. Well, are you including all the books that you're reading? Are you going to any courses? Help you identify those types of things that we can do to maximize those deductions. So I'm going to try and fly through in the 3 minutes we have. Oh, what just happened? Oh no. Try and fly through, well, I guess some of the reasons for below average. I'm not even going to go into that. It's either lack of knowledge, poor record keeping, or fear of Revenue Canada. Lack of knowledge, hopefully these seminars and sessions will help you with that. Poor record keeping, tools like QuickBooks Online will help with that. Fear of Revenue Canada or audit representation protection can help with that as well. Now I want to talk about some of the specific categories and the types of things that you can deduct. First and foremost, for those of you who are new to independent contracting, if you had any expenses prior to setting up your business, as long as they were for the business, they can be deducted. There's no hard and fast rule. We use as a guideline 3 months. As you go any further beyond that, it's kind of hard to justify. Reimbursed expenses is another common expense category. The key in how you track this, though, is really important. you can do it one of two ways. We have a recommended way and a way that you could do it if you so choose. The recommended way is to include the reimbursement from your end client as revenue and include the cost or the purchase of the expense inside of your expense categories. The net effect is there's no tax implication because you've got revenue and then you subtract the expenses, no net impact to you. The other way is to not report it whatsoever. Because there's no net impact, you technically could do that. We don't like that because CRA's number one thing they're looking for is people hiding or not reporting revenue. And so if they come back years down and say, hey, I see this deposit, you haven't reported in revenue, what's going on? You could run into issues even if you have the supporting documentation to defend it. It's not a position you really want to be in. Automobile expense, the most important thing here is you are required to keep a mileage log. There are great new apps and technology to help you keep that mileage log. If you haven't kept one to date, certainly not the end of the world. We've had multiple situations where people have been able to create their mileage log using their calendar reactively, I guess. But ideally, you're being proactive again and keeping those mileage logs using tools like technology to help you automate that as much as possible. With automobile, you are going to have a percentage of use, a percentage that is deductible for business, and a percentage that is deductible, that is not deductible. What we want to do is, again, work with you to help maximize that percentage of use. If you're going out to a networking event, we want to make sure we're including those. All too often, we see people just deduct the actual portion to the end client and home, and that's it, and to their home office. But don't forget going to the bank, going out to meals and entertainment with your wife, who's your most trusted financial advisor, going up to cottages to network with other people in your industry, all those other additional mileages that you might initially think are personal, but as you dig deeper into it, you recognize there are some business-related activities in there that could help your business earn income in the future. Home office, again, we have a worksheet specific for this one. We're going to break out, mortgage interest, property tax, utilities. If you are renting, then we just take a percentage of the rental costs. The percentage of use, again, we're going to have a split between personal and business. If you are renting, there's no limitation on what that percentage of use can be. If you own, we don't officially cap it, but we don't recommend that you go above 30%. And that's simply because your primary residence is capital gains exempt, which means you will pay no tax on the sale of your house. If we go above ancillary use for your home office, we do risk putting your capital gains exemption at risk. So we don't like to do that. So we usually say, hey, even if you're using more than 30% of your home for business, for work, we would discourage you from using more than 30%. But ultimately, it's up to you. Home office, we will again work with you to figure out what that percentage of use is. When we do that calculation for the percentage of use, we look at your total total office space plus the garage, because you're using the garage for vehicle as the numerator. For the denominator, it is the total office space, including the garage, less the common areas, which are the kitchens, the hallways, and the bathrooms. By taking that small little tweak, by including the garage in both the numerator and the denominator, by taking out of the denominator the common areas, kitchens, hallways, and bathrooms, it'll make a substantial increase, take someone who's maybe at 10, 12%, and potentially double them to 20 to 25%, which when you're talking, typically the average person probably has about $10,000 in mortgage interest. This can be a substantial difference in the amount of deductions that you have. Travel is another common one, another common area where you can deduct expenses. The big caveat here is to be aware that SunQuest Vacations is going to stand out like a red flag to CRA. So if you're having a Caribbean destination for travel, make sure that you've documented that as much as possible. It is not unreasonable to have a director's retreat with your other directors of your corporation, but you better make sure that you've documented that with minutes and agendas and that type of documentation to wrap around it. You might be flying to other countries to look at potential investment opportunities for the corporation and rental properties. Again, documentations, business cards, people you met with, real estate agents, appointments that you went to see, all that information is critical to us defending that position. Now, the best thing that you can do is just coincide that travel with a trade show or an event, because it's pretty hard for an auditor to challenge that, even if it's in a Caribbean destination. If you went to Nassau, but it was, you know, specifically for a trade event, pretty hard for them to say that's not business related. Business promotion, meals and entertainment. This is another big win for independent consultants where you get a lot of deductions. As I said earlier, meals and entertainment with your spouse, who's your most trusted financial advisor, meals and entertainment with all your colleagues, and all the people who have the potential to recommend you or provide you input. Even if you're not specifically discussing work at the time, it's all about relationship building. You know, analogy I used to often use is, imagine I was a vacuum salesman, and I asked you out for lunch, and I just spent the whole lunch talking about vacuums and asked you how many vacuums you'd buy at the end of that meeting. You'd probably answer with none, but thank you for lunch, I'll see you later. Now, if I built up a friendship over time, and then we went out for lunch several times, and I built a bond with you, and happened to mention to you that I'm in the, you know, I sold vacuums for a living. Well, the next time you need to purchase a vacuum, you're likely to come and purchase from me. In addition, you would likely recommend me to your friends and colleagues. So it's different styles of networking and sales, but it doesn't make the networking and sales that you're doing any less relevant or any less deductible. So the key thing there is the documentation. So you have to be having a meal with another person. The meal, just because you're doing it while you're at a client site, does not by definition make it deductible. It's the networking and the relationship building and the sales aspect of it, hence business promotion, is what makes it deductible. And one of the things that you are required to do is keep track of who you had that meal with. It doesn't require you to pay for that other person's meal or drinks, but it does require you to be able to say who you had that meal with. And again, looking at this, CRA for some reason seems to think you can't do business development on weekends. So one of the red flags and triggers is often meals and entertainment over weekends, which obviously everyone knows in the real world, business development goes on Monday through Sunday, not Monday through Friday. But just be prepared that those weekend meals and lunches are the ones that are more likely to be challenged. Advertising is an interesting category. It used to be a bigger deduction than it is today, because before the CRA took the position that they are currently taking, we used to advocate for clients to take business clothing and personal grooming as an advertising expense. CRA has won some pretty specific cases in this field, and now have taken the position that all clothing, unless it's for a performance or a uniform, is specifically disallowed. Now, that is not Income Tax Act. That is CRA's interpretation of various case law. I still personally deduct my suits and deduct my dry cleaning as it's specific for work. And I would argue to the blue in the face that that's business related, but I also know that there's a high propensity that CRA would challenge that item if I happen to undergo an audit and could deny it. Now, all the traditional advertising like business cards, websites, you know, LinkedIn, all of that's still deductible under advertising, as are gifts and events. So business promotion is a category that's 50% deductible. The government recognizes that you are getting a benefit from this entertainment and this networking, so they add back 50%. You only get a half of that as a deduction. Advertising is 100% deductible. So if you were having an event, let's say a New Year's party where you're bringing a whole group of people together, that can be an advertising event rather than meals and entertainment. So the criteria when we're moving a event from business promotion to advertising is that it's a group of people, more than 2 or 3, and that it's not happening on a regular basis. So, and by regular basis, I mean like every month. Like certainly it could be regular like every year or even every couple months, but if you're trying to claim going out for drinks with your team every single month, it starts to get harder to defend. Nothing is definitive. Again, everything is in this gray area, subjective scale. And it's up to you how aggressive or conservative you want to be on that. But if you're trying to stay off the radar, if you're having an advertising event every single month, you run that risk. The other thing to note is the other expenses. And I know we have gone long here, so I appreciate everyone who's still hanging on with me. And we've still got over 41 people online, so thank you guys for bearing with me as I've gone a little long. I've clearly got to tighten this up. Is other expenses. Most notably, you will find in our expense category something called Ask My Accountant. So if you're ever unsure, I want you to put it in and put it under Ask My Accountant. I'd much rather have you put in an expense that I have to remove than me get to the review meeting with you, do our benchmark analysis, identify a bunch of expenses that you are entitled to, and you have to go back and either do a best guess and estimate that, or spend a bunch of time going back to locate those transactions. There are also other categories which we haven't talked about today. And our expenses guide, which I will ask Rachel to share with every one of you. I think many of you have it already. It's also available on our portal, but I'll have her send it to everyone so that it goes through all the different expense categories, which again is an introduction. It's not an exhaustive list, it's an introduction. Now, finally, we're getting to revenue here. There's different types of revenue. Contract income, Contract income for most of you is the most common category. We do break that into if you've got it US versus Canadian source income. Accounts receivable, we do need to break out the accounts receivable. So you have to include in your contract income any revenue for work that you performed during your fiscal year, regardless of whether you've been paid for it. We also have investment income and reimbursed expenses, as we discussed earlier. Investment income, as long as you provide us the investment statements, don't need to worry about tracking and reporting that investment income. We will do that for you. We have to, as a requirement, calculate the ACV. Even if the investors give us a statement with ACV on it, we have to actually go through our own process and reconcile each transaction and calculate the adjusted cost base in those transactions for you. So all you need to do is provide us the investment statements, T3s and T5 slips, and we'll calculate that investment for you. The reimbursed expenses, as we said earlier, should be reported as revenue and the expense captured and recorded under the appropriate category. So where to get information, more information? As we mentioned earlier, there is a free resources section on our client zone. It's got access to our CRED, QBO training guide, as well as our chart of accounts, as well as some advanced tax strategies that we use to help guide you to minimize your taxes. So all of that's available. If you would like to get access to a QBO and use that for your bookkeeping process, we can give you a wholesale discount on that. So it's only $15 a month plus HST. You can get access to that by reaching out to either myself or Rachel. In addition, as I said earlier, we will be doing another webinar next month, specifically on QBO, that we will dive into the weeds of how to use QBO to minimize the amount of time it takes you to do your bookkeeping. And these are our different bookkeeping packages. Again, I'm not going to go into that now. I am going to open the floor up for any Q&As, see if there's any more, if we've answered that now. Are travel meals fully deductible? No, they are not. One of the things that changed quite a few years back now is you used to be able to deduct meals while traveling at 100%. You can still deduct meals while travel, but they go into business promotion and it's only 50% deductible. However, what does change for meals while traveling is that the criteria for having it with another person is removed. So all of your meals while traveling are deductible, even if you're not networking or relationship building. So hopefully that answers your question, Ron. Let me jump over to the. Hospitality meals are only 50% deductible. Yeah, I'm not sure what you mean by that, but yeah, meals and travel are 50% deductible. You still report them to us at 100%, and we would adjust that on the tax return. It's actually what they call an add back. So the income statement reports the meals and entertainment at 100% or the business promotion at 100%. And then on the tax return, it's added back so that you're only getting effectively a 50% deduction. And I think that's the last question that we have on board. Thank you again, everyone, for dialing in. Oh, we've got one more question here. Are there any cons to investing the money within the corp versus taking money out of the out to personal RSP and then investing there? I heard you need to justify to CRA that your consulting business has an investment purpose, or they will tax you heavily. And then we got another one here. I'll answer this one question, then we got one more Q&A. Pros and cons of investing in an RSP versus investing inside the corporation. So investing inside the corporation, any investment income that you earned will be taxed at a higher rate. It's not eligible for the small business deduction rate of 12.5%. It's taxed at 38%. Now, big caveat there's different types of investment income. There's interest income, capital gains, dividends, all treated differently. And there's pros and cons of having different types of investments inside the corporation and outside. So the big advantage of the corporation is of investing inside the corporation is you're not taking the money out and potentially being taxed on it. Now, if you're taking the money out and putting it into your RSPs, you're not effectively taxed on it. So an RSP is a great deferral strategy. And having a combined strategy where you've got corporate investments, RSPs, TFSAs is sort of the ideal strategy. May not be applicable for everyone depending upon the stage of the career that they're at. But if you've got RSP room, the advantage that you're going to get is a deferral. And so what I mean by that is with an RSP, when you take the money out, we would have to raise your salary because you've withdrawn the money out of your corporation. But if you contribute it to your RSP, it will reduce the RSP contribution will reduce the taxes that you pay on that salary by the corresponding amount. So there will be no net impact to your personal taxes in the current year. Now, what happens is your RSPs grow tax-free, and you're not taxed on capital gains or investments or dividends. But when you withdraw the money and take that out of your RSP, you're taxed at your personal tax rate on any monies you withdraw. And when you hit 71, you're forced to withdraw that money. There are some potential disadvantages of that, depending upon the type of investment income. Because inside the corporation, yes, you're taxed at 38%, but if it's a capital gains, you only pay tax on half of the gain. So if you have a $100,000 capital gain, you're paying 38% on $50,000, not on the $100,000 gain. So which in effect makes that, cut in half. On the personal side, within your RSP, if you made a capital gain of $100,000 and withdrew that, you would be taxed at your effective personal tax rate on the full amount. And your effective tax rate is going to be at least 30%, even if you're in the lowest tax bracket. You might average to lower than that if you have no other income whatsoever. But that's one of the things to keep in mind. Now, if it were interest income or dividend income, it gets to be a whole other ball of wax. So I'd say we can dive deeper with your individual account manager. There are pros and cons of each, depending upon what your long-term strategy is. And that's where the tax planning comes in, as we talked about earlier. I did not receive the link for this webinar, so I had to join late by 10 minutes. Is there a way to get the recording? Yes, there is. So it has been streamed live on Facebook. So you can go back on Facebook and watch it from the beginning. We will most likely be making the video, which I believe is being recorded, available on our YouTube channel as well. So yes, and yes, and yes. And yep, excellent. I think that is all the questions. So thank you again, everybody, for dialing in. We're down to the last 33 participants. I don't think we have any other questions. I'm a client with Michael. Yeah, reach out to, the best thing you can do is reach out through contact@cpa4it.com, and we'll redirect your messages to the appropriate team members, whether that be me or whoever best could help you. Might be my senior tax advisor, Sean. So reach out to contact@cpa4it. You're welcome. I think that's everything. So thank you, everybody. Have a great day. I'm gonna close out the share here. End our live. Bye for now, everybody.